Fantastic. Yeah, so I'll briefly introduce you to tonight's speakers, and that is Wayne Cantwell, Managing Partner at Decathlon Capital Partners. Next, we have Kim Folsom, Founder and CEO of Founders First Capital Partners. Third, we have BJ Lackland, previously the CEO at Lighter Capital. Next, Keith Harriton, co-founder and managing partner at Novel Growth Partners. And we also have Alan Tier, the co-founder and managing partner at Rev Up Capital. And so we will start tonight's discussion by describing what is revenue-based financing, or RBF for short, and how does it really compare to other capital sources. For the average business owner, there are a variety of capital sources available out there to grow their companies. Capital stacks do include the following. Everyone's very much aware of the traditional bank debt financing. This type of financing typically requires founders to have great personal credit, personal assets to guarantee, and for the business to be very mature and highly profitable. Next, we do have merchant cash advances. This type of capital, it does require that the facility itself can be very expensive with unfavorable and sometimes inflexible repayment terms. And typically, it's better suited for companies who are cash flow on a daily basis. Next, we do have RBF, which we will discuss in a moment. Fourth, everyone's, of course, very familiar with angel investing, which is best suited for super high growth companies that may fall into either high tech or bioscience offerings. This capital can be very difficult to acquire because it does require the stringent relationships and timeframes to get in alignment with investors, and it does require a higher ROI due to the implied nature of the risk. Next, we do have crowdfunding. This form of capital can be best suited for CPG companies that have an easy to understand value proposition, and they must have a large base of supporters that can be easily converted to early buyers. Last, everyone's of course very familiar with the traditional institutional VC funding. This capital, it is best suited for super high growth companies that have demonstrated traction and performance to reach billions of dollars in sales. Think about like Facebook, Google, Uber, etc. So these are usually significant, I would say, promising tech and life science companies. They are also the most difficult type of money to be able to raise for, or at least be able to secure those type of institutional VC funders, because it does require you as a founder to give up a significant amount of ownership and control of the company. And just to be able to gain a better familiarity of who's out there in the audience, we do have a very brief poll. So if you don't mind just answering the 4 questions that you'll see here in the screen in a second.
Awesome. Thank you guys for participating and your responses. It's cool to see everyone, the diversity. It's about half and half for most of the questions. And a lot of people said that they were somewhat or not very familiar with RBF. So it's exciting that you guys are here. Let's see. So in light of the various options and outcomes that Auralia previously mentioned, our discussions tonight is obviously really centered around revenue-based financing. So we'll start with a high-level definition of what revenue-based financing is, and then we'll try to paint a picture on how specifically it works. So revenue-based financing is an alternative method of raising minimally dilutive capital for revenue-generating businesses from investors, who then receive a percentage of the company's ongoing monthly gross revenues in exchange for the money they invested. The term RBI largely refers to the flexible nature of these debt facilities, specifically in the repayment model, to accommodate the inherent, fluctuations in cash flow cycles and revenue levels that these companies can see. The funding structure really is aligned with both the growth trajectory and the variability of early stage companies in the way that the monthly payments are directly proportional to the recognized net cash receipts or gross revenue. At the end of the day, it really is a way to efficiently and sustainably grow your business with minimal strain on the founders is the goal. So we'll breeze through a couple more details and examples, but want to make sure that the experts have time to touch on this. So in a little bit more detail, each loan or tranche will typically be sized based on a multiple of the company's recurring or repeatable or contracted revenues. And then that principal amount lent will be assigned a fixed repayment cap that dictates the total amount to be repaid over the course of the term. That amount is then reached by making variable monthly payments that are calculated by taking a predetermined single-digit and fixed percent of the company's net cash receipts, often referred to as the royalty rate, until that total obligation of principal and interest is met. So on the next slide, I believe there's a quick example. So here you can see it's a structured $200K debt facility with a 1.5x return cap, which is equating to a total obligation $300K, $200K of that being the principal, and $100K of that being the interest portion due by the end of the term. And then this example has that 5% of monthly NCRs, net cash receipts, being taken until the full loan is repaid. So all this being said, we'll just quickly summarize the benefits before we move on to our expert panelists. So number one, limited financial covenants. With the repayments depending only on company performance, you're not on the hook for the same hefty payment if you experience a down month as if you experience an awesome month. There's no loss of control, so no board seats taken, no ability to replace management or take control of operations, and most importantly, no large chunk of equity being sold. No pledge of real estate assets or personal guarantees of any kind in some cases, so no requirement to collateralize. And then aligned interest is huge. So our IRR depends on your performance and growth, and your burden on the monthly cash flow is directly aligned with your internal cash collection cycles. And then ongoing strategic advice. So we always like to emphasize being long-term partners to help and support the company's growth as our repayment is directly tied. So some investors provide this, including founders and some of the other panelists here today. And then lastly, just the great retention of value and ownership upon exit is really huge. So because there's no sale of equity happening with this type of investment, the business owners are really able to retain the greatest amount of control possible and in any sort of M&A activity.
Oh, that was so beautifully summarized. I like that. All right. Let's go ahead and meet our panel of experts who are leading, again, some of the top-notch leading revenue-based funds here in the U.S. We'll start off with Wayne Cantwell at Decathlon Capital. We'll start off with the super easy questions. So Wayne leads one of the largest revenue-based firms here that is responsible for writing the largest investment checks. If you don't mind, Wayne, can you please share with us and the audience a bit about your background and overview of Decathlon and your focus on RBF?
Sure. Can you hear me okay?
Yep.
Perfect. So as you can tell by the slide, I spent about 16 years as an operator. Following that was in venture capital for 10 plus years. And then my partner and I in 2009 concluded that there needed to be a better way to do growth capital funding. Equity was the product that we were mainly selling at the time as venture guys. And we just felt in so many cases it was not the best solution. So we set off to start a business to do this, be entrepreneurs ourselves. And now we're, coming on over a decade of experience doing this. The reality is that if you're in the very shiny spot for the venture world, you can get funding, you can get lots of funding. But if you're a bit off or way off, you have very little chances of getting, meaningful capital. And so from the very beginning, our whole idea was to give those companies that deserve to have that, nice fat check for growth, but didn't want to sell their stock. And we've been doing that. I don't know, we must be approaching 170 companies at this point that we've done over the last decade plus in time. And, I don't know, currently we're doing somewhere between 35 and 40 deals a year, covering the country, from Florida to Seattle, and everywhere in between. So pre-COVID, we all spent a lot of time flying back and forth across the country. It's a little different now, but that times will change eventually, going back to normal. We're broad-based, meaning probably roughly about 35% of our business are in SaaS companies or software companies in general. And then the next biggest category is healthcare. A lot of stuff in healthcare across a lot of different spectrums there. The next one is, I call it FBA, food, beverage, and alcohol, is probably the third largest category. And then consumer, direct-to-consumer stuff is low single digits. And then we have a very big bucket of what I call other, which ranges from, someone who maybe makes a specific piece of equipment to someone that puts tents in the middle of national parks to give us all the opportunity to camp without bringing our own gear. So you almost can't imagine the diverse level of fundings that we've done. But they all have one thing in common: is they're growing very nicely. They're on the verge or are profitable. They have a good gross margin profile, and a really solid team that's running the business. And once you put all those things together, we'll look at almost anything. As it says here, our check size is between 1 and 10 million. 2 to 3 is the most typical number, but every year we're doing stuff smaller, rarely less than $1 million, but 1 to 5 is much more common. We have the ability to go bigger, and sometimes companies grow into that size. And sometimes it's something that happens organically, but most of the time in this space, what you're going to find is someone who's looking for between 1 to 5 million when they come to us. If you look at sort of the overall portfolio, about 34% of our companies fit in the impact category. Roughly 16 to 17% are led by people of color. So we've got a significant amount of folks that are also from different sort of spectrum, whether it be veteran-based or women-led or, different sort of specialities. But at the end of the day, we look, across the country at all kinds of businesses, several thousand per year, and we try to fund as many of those as we have bandwidth to do.
That's very impressive. Amazing. Thank you for sharing that insight, and congratulations on the amount of checks that you guys are writing on an annual basis. Awesome. Over at Founders First Capital Partners, can you please share with us a little bit of a background on yourself and specifically on the firm that you're leading as it relates to RBF?
Thank you so much. I'm so excited to be here. And thanks, guys, for allowing me to twist your arm to join me in educating more people about revenue-based financing. So I came to revenue-based financing kind of from being on the other side of the table. I was a founder of a company, 6 venture-backed companies, technology companies, where I sold most of the time equity in my companies and had 3 exits and thought, you know what, there's got to be a better way so I can keep ownership of my business and have more control about the exit. And so that's where that was what led me to revenue-based financing. But I also would share that what we do at Founders First is we focus on funding the gap for diverse founders, smaller companies than what Wayne mentioned. Our companies are generally, $500,000 to $5 million in revenues. They are the folks that, most of them, and like I did too, started my company with either savings or 401k, get it to a certain size. And they may not be able to get access to traditional debt financing because they may not have the personal real estate assets that are needed to pledge that. And then they don't have the relationships to get institutional venture capital. And their businesses are growing, I would say, they may have been growing 5 to 10%, and with this capital, they can get on the path of growing, 25 to 50% year over year. We specifically, we have both an accelerator and our direct revenue-based investment, and we focus that 70% or more of our companies that will fund will be in the persons of color, women, military veteran, LGBTQ, and underserved communities. And it's been exciting because, I can so relate, some 25 years ago where I was, the same person in their shoes trying to get people to convince people that, I'm a square peg trying to get into a round hole, but write me a check and see what I can do. And so, those are the size companies. They're with us. They're service-based, light manufacturing. They're profitable. Our typical deal size that we're looking at is $250,000. Although we have been able to do a range of 50 to 250, and then we can do follow-on up to $1 million. We do provide post-funding advisory support. We look to do something in the neighborhood of 30 to 40 transactions per year. And anyone who are interested in finding us, you can go to foundersfirstcdc.org.
Thank you so much for that insight, Kim. As someone who's been very fortunate to see the impact that you're having on a daily basis, I'm so excited to just listen and be re-energized with the why you enter RBF. Next, I would love to introduce you to BJ. He used to be formerly over at Lighter Capital, and now most recently he's with IBI Spikes Fund. BJ, you did not know this, but before joining Founders First, I was actually able to learn a lot about RBF thanks to you and the material that you put out there. So can you please share with us a little bit of your background and the focus that Spike Fund has in regards to RBF?
Sure, yeah. So I spent 20 years on one side of the table or the other of funding startups. So not unlike Wayne, Keith Smothers here, I spent some time in venture capital, about 5+ years as a VC, doing like Series A deals and such. Also spent some time as an operator, CFO of a public company, things like that. And then came to RBF about 10 years ago. So I started at Lighter Capital in 2012. The firm was started in 2010. When I started at Lighter, the firm made only a handful of loans. And during my 7.5 years there, we grew up to doing a total of about 650 deals for 350 companies, much down a significant notch from like where Wayne and Decathlon are. So our average funding size by the time I left in 2019, we did about 150 deals, but the average funding size is about $375,000. And we were providing on average about 2 loans per company. Our target really at Lighter was very much software and related kinds of businesses. So very, very heavily into tech and SaaS companies. About 75% of the deals we did were SaaS, but there were also some companies that were tech-enabled services or even a little bit of e-commerce and things like that. We were venturing out into more before I left Lighter. So, but mostly really sticking to that SaaS and really very much valuing those recurring revenue streams that you see with a lot of SaaS companies and funding against those. Where I am now, I'm involved at IBI Spikes, where I'm a co-founder and CIO. IBI Spikes is based out of Israel. It's funding very much similar kind of target to Lighter, maybe a little bit larger deals. We're targeting doing deals anywhere from about $300K to about $4 million. Very much towards like B2B SaaS companies, some consumer technology plays, B2C type of stuff, or tech-enabled services as well. But really basically taking a very similar model overseas is what we're doing. I'm also pleased to say I'm on the board of Founders First Capital Partners, helping Kim and the team grow the business here.
Amazing. Thank you so much. Next, Keith, same question to you. And I can't believe I get to hear more from you because I've been able to attend every one of your other RBF webinars.
No,
I know I go to every one of them. So if you can just also same question, just share a bit of your background and then your focus on your firm's investment thesis as it relates to RBF.
Yeah, sure. Nice to be on the other side of the conversation tonight. So Hey, everybody. I'm Keith Harrington, co-founder and managing director at Novel Growth Partners. We're a revenue-based financing firm based in Kansas City. I guess my path to revenue-based financing is pretty similar to, I think, most. I had spent the 5 or so years prior to founding Novel doing venture investing, particularly in the life sciences space, on behalf of actually the state of Kansas. And after that, had co-founded another venture fund focused on ag tech and other life sciences kinds of deals. And what I found was I was spending just a ton of time talking to entrepreneurs who I wanted to work with, but I couldn't find a way to work with most of them, right? If they weren't on a unicorn path, if they weren't the brightest and shiniest of stars, I just didn't have the right kind of capital for them. And so I started to get pretty frustrated with what I was doing. I spent all my time saying no. And I think, like everybody has said before me so far tonight, I just got to the point where I realized there's just got to be a better way. There's got to be a way that I can actually do something helpful. There's got to be some sort of capital that can help entrepreneurs at different points in their journey. And went kind of deep on that question in 2017 and landed on revenue-based financing and partnered up with my partner after that. And we've now got a portfolio of, I think we've done 40 investments across 26 companies. So we usually do a couple of investments per company as well. And it's just been an incredibly rewarding experience so far, because we're able to work with entrepreneurs who have a different point of view, a different approach, and are looking for a different kind of an experience growing their companies. Although I will say that probably 40% of our companies do have some venture capital on the cap table. So it's a really interesting tool that we can use in a number of different use cases, really. Our particular thesis, we focus mostly on software businesses. So certainly SaaS businesses, but also tech-enabled services. Basically, if it's a B2B software company, we'll definitely take a look. We look for companies with at least $500,000 in revenue over the last 12 months, up to $5 million in revenue. And we'll write checks from $100K up to $2 million. Our average is just a little bit over $300K today. And one of the things that we do that I think is that the CEOs that we work with really love is we have what we call our revenue acceleration platform. And that's very structured, systematic work that we do with CEOs and sales leaders of the companies that we work with to help them really try to accelerate their growth curve.
Awesome. Thank you so much.
Yeah.
And then finally, I'd love to welcome Alan of RevUp Capital. I'm going to have the same question for you, Alan. If you can please share a little bit of your background and then the focus on your firm as it relates to RBF.
Sure. Hey, folks, this is Alan. I'm the co-founder, managing partner of RevUp. We launched the fund in 2015, started making investments in 2016. We have about 30 investments in the portfolio, and we'll make 15 to 20 this year. I came to this first as as an entrepreneur, and then as an early stage venture investor, much like the other people on the portfolio who, after 90 early stage investments in our equity portfolio, just realized that what I had set out to do in co-founding that seed stage fund wasn't happening. I really wanted to expand the set of options for founders in terms of successful outcomes on their own terms. And instead, we had become rung zero of the venture capital ladder, and we're still norming towards this unicorn or bust pathway. And so I really saw revenue-based investing as being another chance to give founders more options, to let them create success on their terms. And that is what we're focused on at RevUp now. we really focus in on the $1 million to $10 million journey for companies. So most of our companies come into the portfolio at about $1 million of revenue. We'll go a little lower, a little higher than that. And we focus in on investing cash, usually about $250,000, and then an optional set of services around our growth platform, which is a dedicated team of digital marketing and sales ops folks that act as a critical capacity component to the company for up to 12 months after we make the investment. Our observation was just that companies at around $1 million don't have all of the people around the table that they're going to need to power the next phase of growth. And we fill that in with a set of structured growth experiments to get them onto the next growth curve more quickly and more predictably. So that's our focus. In terms of kind of deals, we're all over from about 40% niche SaaS, 30% e-commerce, and like Wayne, a 30% other category. Got everything in there from a cookie company to a data science training company. We like revenue no matter what container it comes in.
You love revenue. I love cookies.
Yes.
Awesome. Well, thank you, everyone. We'll hear from you again shortly, but let's shift gears just briefly, and we'll talk about how revenue-based financing works in practice, and hear specifically from each of you guys about how you've used the innovative funding model to help these founders grow their businesses. So first, let's start with Wayne. Will you please take us through the success story to illustrate how the large cap companies you typically focus on at Decathlon leverage the revenue-based financing for growth?
Sure. So we didn't get the opportunity to give the company name here. We needed time to get that permission, but I can walk through it anyway.
No problem.
This particular company was a business process outsourcing consulting company. As you may know, consulting services are something that you almost never can get traditional equity funding for. This particular group had bootstrapped themselves with no financial sponsor, just kind of like Kim had mentioned, from their own savings account, 401ks, whatever, but very, truly a bootstrap company. And they were basically helping companies across the globe deal with, how to basically, improve their manufacturing and cost models. And so their clients were typically Fortune 1000 or Fortune 500 companies. Rarely were they long-term contracts. I mean, here or there, they would continue to get business with people year after year. But most RBF programs generally prefer to have that, recurring revenue on a regular basis. And this is a company that did not have it. But it was a very dedicated set of founders who were basically looking to grow the business. They had a lot of opportunity, and the way their business worked, they had to put some investments up front. Each time they launched one of these major clients, per se, they had to hire some people and they had to get it going ahead of when billing. And so in a traditional venture-backed company, that would normally be what your equity dollars would be used for. But they didn't have that luxury, so they found us. And effectively by putting together a package for them, which was $4 million, they were able to grow the company. They invested sales, marketing, and even sort of operations and even some specific technologists in the practices they were in. I forget the exact length of time, but I'm going to say about 3.5, maybe slightly 4 years. They continued to grow year after year, and they were approached by one of the top 3 global consulting firms who ultimately ended up buying them. It took some time. Obviously those big consulting firms are not very acquisitive and they don't move quickly. So we helped the company through that whole process, and ultimately they ended up all having, what I would describe as life-changing wealth events that basically they had, all the stock was within the company. They didn't have investors to give it out to, and, they had been growing very nicely. So a significant part of our own cash had been paid through the life of the project. And so when it came time to actually, do the closing, sure, there was some money to go to us just to finish up our particular package, but the founders got to keep the money. And we thought that was just a wonderful outcome. And kind of, I think it was Alan or Keith made the point, having been on the other side of the table and funded, I think I've been on 20 something venture boards or venture advisory boards. And so many times you see so many of the dollars going to the venture firms, and, the management or the people who did all the hard work don't get to participate as much as maybe they should. And this package was a perfect opportunity for those. $4 million is very much like you might have in an early stage venture round. It's big enough to do something real, and they put that money to work and executed on their goals, and everybody was very happy in the end. We looked at it as, hey, $4 million for a company like this, no one else is going to fund that, but we knew the company had good team, good customers, good margins, good trajectory. So we knew it was going to be a success. It's just a matter of when.
Great. Really appreciate you sharing that story to everyone. I think next we have Kim. No?
Yeah, that's me.
And Can you just take us through how the type of diverse founded and service-based companies you focus on at Founders utilize revenue-based financing?
Certainly. So I'm super excited to share this particular example. This is a representative of, the type of companies that we fund. And so I wanted to highlight this recent one that we happened to do. This company was a technology services, IT services, a actually certified Microsoft solution provider that wanted to have more specialty and add some tech enablement. And so, typical service-based company, and, generally, they not attractive to VC and angel, because it's not a proprietary IP heavy, tech company. But, this company was founded by a corporate mid-market executive that really honed her skills and leveraging IT services on the one side, as well as knew quite a bit in the life sciences environment, be it either pharmaceuticals, medical devices, and all of the rigors that they had to go through in order to get their approvals from major agencies like the FDA. So she wanted to, create a more niched focus based on the services she had been providing to these clients for over 12 years, and add some proprietary technology that would help them to do this and provide more of a subscription base. But making that transformation is not something that a number of traditional equity investors want to do in a service-based company. And so she initially took very, very small amounts of traditional debt, but there's limits with that, banks and those types of places. We talked about, merchant cash advance. They generally will provide less than $100,000, which it's really hard for you to make an investment in, creating a solution and then hiring, 2, 3, 5, team members with, less than 100,000. And so, as I shared with at the earlier part of the webinar, our model is that we have both an accelerator and also on one side of our business, our nonprofit business growth accelerator, and then our for-profit is a direct investor. And so this entrepreneur joined our Fast Path program, which was targeted to businesses 1 to 5 million, with a goal of getting a growth partner that could fund her making that transition from being just a core service-based business to a tech-enabled service-based business. And she had built up a really great pipeline of customers. And so the cool thing about this is we were able to do a syndication of investment for her with one of our partners that are on this call, Novel Growth Partners, to provide her with a revenue-based financing package of $500,000. And that allowed her to really close quite a number of businesses on her pipeline. And, since that time, she's grown like 1.5 times. And has gotten, some recognitions within the industry as well as others with regards to what she's doing. So it's super exciting to be able to help, a service-based business become a tech-enabled service-based business, to be able to get, more than, the typical cap of 100,000, and also having the flexibility to help her grow. And then the third is we also provide her post-funding advisory support as she looks to scale on the path of, getting high 7 and 8 figures.
So interesting. Thank you, Kim. Love hearing how passionate you always are too. Next, we'll hear from BJ. You can take us through how many SaaS companies you've funded in the past with Lighter, and now the IBI Spikes Fund utilize and thrive from the revenue-based financing.
Yeah, this is a example actually from Lighter, a company that Lighter funded, actually provided 5 rounds of RBF funding to. It's a company that actually ended up being called Map Anything and having an incredibly successful exit. And one of the reasons why I chose it is because a lot of the information is public. It was eventually acquired by Salesforce for $250 million. But it started off as a Salesforce managed services business that had a couple apps that were starting to get a little bit of traction in the market. And so at Lighter, we saw, this great company that had kind of these recurring revenue streams, this combination of managed services and some apps kind of going on. But its revenue was relatively flat. And so it wasn't really that interesting to a lot of VCs. And John Stewart, the founder, is very vocal about the fact that he had a terrible time talking to a lot of VCs in the early days. And so at Lighter, we saw like a nice recurring revenue stream and a relatively break-even business and a super dedicated founding team, and provided them initially like $250K, and then it just kept on being another $250K, another $250K, another $250K, until it grew up to a total exposure about $1.2 million. At which point in time, the company had really honed in on a mapping application on Salesforce, and that was just totally taking off. And so they ended up, somewhat uncommon for the Lighter portfolio, they ended up going and raising VC and ended up raising a Series A from Graycroft. And then they raised an additional like Series B and C and ended up raising about 40 million in total VC. So really large amount of VC for a Lighter capital portfolio company. But we're sort of a great example where at the end, the company had this big notable public exit. But if it weren't for taking some non-dilutive funding early on, the founders would have been really significantly diluted. Instead, they were able to effectively like skip a ton of dilution that they would normally have had from early stage financing, and ended up making like truly, sort of multi-generational wealth for the founders in a way that just never would have happened if they'd gotten diluted in a seed round and an early Series A and things like that. So a little bit uncommon in that they ended up being very VC backed and having a big public exit. But I like the example just because it is all public, and the entrepreneur is very open about his experience.
Yeah, such a cool success story. Thank you. All right, next we'll hear from Keith. Can you take us through your case study to show how the specific type of education and tech companies that you focus on at Novel utilize the revenue-based financing?
Yeah, so Branching Minds is a company in New York City. It's in the ed tech space. They do sort of evidence-based interventions to help learners overcome whatever obstacles may be in their way. And I don't know if any of you are super familiar with ed tech, but it as a sector is wildly seasonal. It's totally predictably seasonal. When the big months are going to be, and you also know when the small months are going to be, but that makes the business super hard to manage, right? And the founder, Maya Gatt, she'd gotten to north of $1 million in revenue getting grants from the government, but never taking any venture money. She had a couple of angel investors, and even that was a minimal amount, but she was super sensitive to dilution and couldn't really get decent attention from VCs, even when she was trying to raise it initially. So we met her and we looked at the company, and we actually know quite a lot about the ed tech space. My co-founder and partner built an ed tech company and sold it to Vista Private Equity in Texas, and so knows the space super well. So we were able to get really comfortable and really familiar with the business really quickly. Understood the seasonality, could see the kinds of challenges that Maya and her team were facing. And did an initial investment with her back in 2019. So this was about 2 years ago that we did the initial investment. And the first investment that we made was really focused on helping her blow out her sales team. So she brought on a bunch of new sales talent. We helped her with our revenue acceleration program, actually build an outbound sales machine, an outbound lead gen machine, and then hire the right kind of salespeople. She has now gone on, since we did this initial deal with her in 2019, to 5x the number of clients, the number of students that she's touching. And then we did another investment with her about this time last year. So she's just been on this wild growth curve. Now she shuns venture money altogether because she's running what is essentially a profitable business, and she doesn't need to take any more money. But that was most of the companies that we work with are kind of like that. They make the choice at some point to really pay attention to the bottom line, try to get to profitability, and take on money that will really flex with them as they grow.
Yeah, that's great. Really hit all the nails on the head with that. And then last, we'll hear from Alan. Can you just please take us through the case study to show how the e-commerce and tech companies that you guys focus on at RevUp are utilizing this?
Sure. So I'm actually going to talk about a company, a software company in our portfolio called Zubean. Zubean was co-founded by a husband and wife team. He was a Washington, D.C. Teacher of the Year turned tech entrepreneur, had a previous startup, and his wife was former head of K through 12 education at Google. And they created Zubean, kind of ended up pivoting from a consumer product into an enterprise product built around digital literacy to increase reader engagement and literacy, mainly using libraries and now schools to access young learners. And they're now used by over 1,000 schools and libraries around the world. We made that investment, as the company was post pivot and was seeing traction in the library market. And I think one of the things to understand about the flexibility of revenue-based financing is a lot of companies that are interesting to revenue-based investors that maybe aren't interesting to venture investors has to do with the terminus point of the market that they're in, right? So most VCs would say that libraries, and a lot of VCs are also not interested in the K through 12 school market as well. It doesn't mean that this company wasn't growing fast. I mean, they've 5x the revenue in the past 24 months since we made the investment. But they happen to be in a set of niche markets that are not as well served by venture investors, or in the case of EdTech, have kind of fallen out of favor in this particular venture cycle. So a lot of times it's not because a company is slower growing. It's just that they may be in a market that's more niche or have a lower terminus and not turn into a $1 billion market. One of the things we were able to do with Zubean is use our growth platform in addition to the cash to help them explore new markets, both breaking into the individual school building market rather than just districts, as well as testing out and adding in consumer products on the app and on the physical product side to give them more reach and more opportunities to grow. And so as a result, as I said, they've 5x the revenue, about a team of 25 now.
Great. Thank you so much.
All right. This is amazing. I'm taking as many notes as I can because the case studies are definitely very insightful. All right. So now we're definitely going to be opening up our Q&A portion of the webinar, and I'm going to kick off this question with Keith. So as you've seen here with our panel, everyone's firms on this evening's panel, they have collectively funded thousands or more companies, yet RBF funding remains less known, whereas equity funding, it's widely praised and it's always been hyped up in the media. So given all the benefits and advantages of RBF for founders, Keith, I'm curious to know, what initiatives is your firm working on to increase the awareness of RBF?
Oh, wow. So what initiatives is Novel Growth Partners working on? Well, I guess first and foremost, and perhaps most fundamentally, we are trying to get in front of as many entrepreneurs as we possibly can, and trying to fund as many entrepreneurs as we possibly can. We're actually in what I would characterize as a bit of a growth mode. So that's the first thing we're doing, is trying to get in front of as many entrepreneurs as we can to try to help change the funding mix out there. I mean, we all know that every entrepreneur is taught that they should go out and raise angel money, and then they should go out and raise venture money. But nobody ever says, you know, what you should really do is take a step back and really think carefully about what kind of capital you should raise. And here are some other options for you, revenue-based financing being one of them. Nobody is out there delivering that lesson very loudly, except for basically everybody whose pictures, you know, you're seeing here. And I think that's for a couple of reasons. One, venture is obviously so entrenched. It's just what everybody's used to thinking about for financing their early stage companies. Let's be honest, the sexy stories come out of venture capital, right? Those are the ones that have the most. Those are the ones that people get most excited about. And revenue-based financing, I think it's pretty sexy, but maybe it's not like objectively as sexy as venture capital, because it's not sort of the shoot for the moon kind of approach. And so one of the things that we do is we try to teach and share with entrepreneurs that this is a way that you can grow at whatever pace that you want to grow and still manage and run the business that you want to manage and run, right? You can still hit all of your goals, but you get to manage the cost of your capital. And I think that's a crucial thing that entrepreneurs have the option to do. They just don't always know that option exists. One of the things that I personally do is I try to connect with all of the revenue-based financing investors that I can. And you mentioned a little while ago, I do an approximately monthly webinar with another investor where I ask them questions about how they approach the market and what they do, and try to get the word out that way as well. But I think the most important thing that we do, that I do, and probably that everybody here does, is we just find great companies to fund. And we keep telling that story, and we keep doing it over and over again.
Thank you so much for that information. And yes, I agree. RBF is very sexy.
Thank you. Thank you.
Even though we don't require, that's not a requirement for anyone to get funded. Okay, so no worries. But I'm curious to know from Alan, how would you say that RBF is different from other profit sharing practices, maybe like firms like NDVC?
I think we're actually building a set of what I sometimes call equity alternatives along a continuum, and I think it's useful once a founder has opened their mind to equity alternatives or venture alternatives to understand the difference between a Clearbank, NDVC, a Lighter, a RevUp, a Novel, a Founders First. So there are differences in between RBI firms. There are differences between close substitutes, other firms that use revenue as part of their calculation. And there are these hybrid, equity revenue funds like Indy. I think the first thing, though, rather than pointing out the differences, is to point out that these are all building blocks along a path to either avoid traditional venture altogether or to give yourself alternatives along the way. Like Keith, our portfolio has a 30% overlap with venture, but we definitely, want to provide either exit paths, paths to get off that ride, or alternatives when it's too soon to tell. So, to answer your question specifically, Indy and Earnest and some other funds that are focused on, those funds are focused on a little upstream, earlier stage, start out as equity, but then be able to convert into a revenue agreement. Whereas I think, and so they were able to invest a little earlier than strict revenue-based investing or revenue loan funds are able to. But there is also then an equity component. So you're kind of starting to take the ride a little bit. There's just an obvious way to get off the equity ride. Whereas, we're the people on this stage are really focused solely on kind of revenue in, revenue out as the math.
I like that. Thank you. I love the fact that you mentioned let's focus, seeing it more as the building block. That's really insightful. Yeah. Awesome. Thank you for that insight.
So the pandemic is, I'm sure, still on everyone's mind. So I'm curious from Wayne, on average, how have you seen revenue-based funded companies fare compared to those that are funded by traditional debt or equity sources? Have you experienced any major discrepancies, or is it pretty even across the board? What's been your experience there?
I don't know that I have the data to compare it against other lending sources. I haven't seen any studies on that, but I can tell you our experiences. COVID, on the one hand, it affected most companies at one level or another. But interestingly enough, there are companies that have done very well. If you go back to what I said earlier about the buckets that we have generally done, so over the last year, the software companies have done great. Maybe someone has a 10% drop in revenue or something, but most of the time that's just been a timing issue. It's not been something that's been permanent. So I would say in general, that category has done well. Second category is healthcare, and depending on where you're at in healthcare, if you may recall, there were many months where no one went to their dentist. Well, I'm not sure who's going to their dentist yet, but no one's going to their dentist or their dermatologist, or I don't know, their any of their general elective, don't get Botox or whatever. So a lot of these types of healthcare companies really suffered during the last 12 months. The PPP campaigns have been really helpful to folks. The EIDL, emergency loans from the SBA, have been very helpful. And firms like all of us probably had to step up for our portfolio at times. And then the next category I mentioned was food, beverage, and alcohol. And I think I can just say universally, we all have eaten and drank a lot more during the pandemic. So that category has done very well for us. And the other bucket, much to the point of Alan, it's a very diverse set of things. We don't have a cookie company at the moment. We did have one a long time ago, but we have a lot of diversity in that particular bucket. And it's almost random. Some companies are crushing it. I have a company that does housewares like made from custom steel. And I guess we all woke up last May and said our house is not very well decorated, and they are just crushing it. And so it's called Redline Steel. They basically make all sorts of interesting housewares that might go on your front door or on your wall or whatever. And consumers decided they really wanted to do that or to buy those products. So it's really been a tale of where were you at in the consumer's mind and in the B2B place. And if you were in the right place, you crushed it. If not, it's been really challenging. We have some companies related to travel. And as you may know, how many of you have been on an airplane, or how frequently in the last 12 months? Maybe most of you have once or twice, but maybe traditionally it would be every few weeks. And so that's an example of a category that's been really struggling over the last year. But having said that, we have started to see almost universally numbers creep up now. So I could definitely argue that we're probably past the trough, because probably like all of you, we get revenues reported every month from all our companies, and we can do month over month, year over year, quarter over quarter comparisons instantly, and we can just see exactly each month how things are going. And we're definitely seeing a positive uptick, almost universally. Maybe a company here or there that's struggling, have someone that sells all of their products into theme parks like Disney World, SeaWorld, Six Flags, Walt Disney World, and stadiums, basketball and football stadiums, and airports. Wow. So to have that as your three major market segments, that's not a good place to be right now. So someone on that end of the spectrum has really been struggling, but on the other, if you can't make enough of your food product, you just are doing everything you can to grow as fast as you can. So it's a tale of two worlds. You're either on one side of the coin and it could be really bad for you, and the other side is doing really, really well.
Yeah, that was right in line with, I think, what we've all seen too. So I appreciate the insight. The next one is directed at BJ. So most SaaS companies are typically going to be funded by angel investors or VC investors. However, Lighter Capital and now IBI Spikes have definitely focused on funding hundreds of these companies, either alongside as a flexible complement to or as an alternative to the more traditional forms of fundraising. So we're curious how, in your experience, how you've seen this funding model specifically benefit the SaaS companies that you've worked with.
Yeah, I think it's certainly provided a couple different avenues. I think a couple different benefits. I mean, number one, kind of like the case study I gave example of, is just reducing dilution for the entrepreneurs. And that was kind of an extreme because it was such a large exit. But there's so many times at Lighter, we saw companies that would be acquired for sums of money that would be both worthy of coverage in TechCrunch and well over worthy of like life-changing money. So, a $20 million exit where the founding team still owned 60% is life-changing money by most people's definition, and would happen with some degree of regularity. And so I think that that results because of a couple different things. Number one, VC funding, as some of the people, other panelists have alluded to, is a bit of a barbell type of outcome. And on one side is a zero, and the other side's like a unicorn. And that's rough on entrepreneurs, whereas a lot of RBF funded companies tend to be in the middle. And I used to have sort of a stock spiel I would give entrepreneurs when they were thinking about getting off of revenue-based funding, and they'd gotten to like their goal of 5 or 6 million in revenue. And they're like, we want to get to 6 million in revenue and then raise a growth equity round. And they're like, okay, we're at 6 million in revenue. We want to go raise a $20 million growth equity round. I'm like, okay, just so you know, if you go do that, your chance of making $100 million goes up. Your chance of making $0 also goes up, and your chance of making 20 million probably goes down. So you got to decide what you really want in life. So I think that one of the benefits that RBF provides vis-a-vis more traditional, especially sort of high octane VC money, is it provides a lot of optionality for entrepreneurs, right? A standard like growth equity type of round might have a provision that says you can't sell for less than $100 million without the VC's permission. Well, no RBF fund cares about that. They just want to get their money back and pay back their multiple. So if the entrepreneur decides, you know what, that's it, like we had a great run, but we're pulling the ripcord a year after financing because we got a cool offer and we want to go do something else, RBF is great for that. Venture capital is horrible for that. So I think that it provides a bunch of things, and a bunch of things that you'll see from everybody here in terms of the value props of lower dilution and no board seats and things like that. I think the one though that I'd point out is we all kind of underplay a little bit because it's hard to articulate, but it's actually fundamentally more important to the entrepreneurs is that you keep open a lot of optionality. You can then go raise VC if you want to. You can go for, depending upon your RBF lender and stuff like that. A lot of them, you can go raise bank financing if you want to. You can just run the thing out. You can sell the business. You keep a lot of control and optionality open. So I think that that's what I see a lot. And then a lot of what people will consider small exits, because we're all trained to think about, unicorn and exits of 100 million plus. But a lot of small exits that happen that are life-changing. And one further note on that too, small exits, a lot of times, small exits, I mean like, things that are sub $100 million or whatever, are actually far more common and easier to do. A lot of big companies give budgetary discretion to department heads to go do a $20 million acquisition. Whereas if you're going to go over $100 million, you're going up for CEO signature, and you never know what happens. So a lot of those acquisitions can happen much more quickly and such too, and end up having just as great a benefit or more for the entrepreneurs.
Great. Thank you for sharing.
Thank you. All right, so the next question here will be for Kim. Kim, you're leveraging RBF specifically focused on service-based companies that are founded and led by diverse founders. What, in your opinion, given your extensive background, why is this funding model a better fit for this market than your more traditional bank debt or your equity funding?
Thanks so much for the question. A couple reasons. One, it's not most. If you look at more traditional small businesses, most of those are using like SBA, heavy personal asset based financing, where you have to have a strong personal financial profile, and you need to have personal financial assets, a house or something like that, to pledge against it. Which there's been so many things published in the last 5 years about the wealth gap for businesses led by diverse founders. They don't happen to have those things. Generally, their credit is our credit is less than the desire to get access to a significant six figures of capital like we're talking about in this call. And then the other side of it is having a substantial amount of equity in your personal real estate such that it would allow you to get that. And then on the other side, with venture, I mean, there's venture is hard enough to get access to, and there's been less than 5% venture capital that goes to most people of color. And then when you look at specifically Black and Brown founders, it's less than 2%. And so the thing that I like most about revenue-based financing is it's almost like playing sports. You have a very transparent playbook. It's based on the numbers. If you have this particular amount of revenue, you have this particular amount of gross margin, you have this particular amount of track record with regard to your financials. It's not, that biased, type of situation where you don't really know where you stand. And generally, it's based on math that you can make certain how you qualify. And then if you perform, you can get access to additional follow-on fundings. All of us on this call talk about that. We start with an initial funding. Many of us are generally in the six figures. For Wayne, Mr. Big Deal on our call, but most of us start at six figures. And if you prove yourself, then you can get access to more capital. That is generally not the opportunity for most diverse founders, and so that's really super exciting to be able to provide folks the capital to hire, people and provide them premium wages, to, add some tech enablement to their solutions. Because the other thing with founding diverse founder-led businesses, they generally are hiring other diverse employees to the tune of 70 to 95%, especially like veteran-led businesses. Generally, those are 90% other veterans that are, makes up their employee base. So it is a tremendous impact to their community. And so, it's exciting to be able to be on the other side of the table and help grow these businesses and not have some of the limitations that because of some of the challenges and wealth gaps that you just can't overcome, be able to do this. It's much more forgiving. We've had some of our founders share that, where they've gone to more traditional banks and there's errors that they've made in their 20s that now they're in their 40s trying to get financing and not have to continue to pay for those sins that happened with regards to some decisions. And then the other factor in comparison to equity financing, generally an equity fund, 25, 50 million, they're doing, a small handful of transactions every year, where in founders, we get to do, 10, 20 times that. So on an annual basis. So those are some of the reasons why, as I share, with us, we get to major in the minors and help these companies, increase their revenues by, 3 to 10x. And it may result in a win that's, a single or double, as opposed to the grand slam that many VCs are looking for.
Great. Thank you, Kim. So Alan, Keith, and Kim, each of your firms offer the funded companies post-funding advisory support. And we did just get a question in chat about this as well. So maybe we can hear just a little bit from each of you on the benefits of the company and what goes into that.
Sure, I'll start first. Many of our companies are first-time founders, And even if they've been running their business for 5 to 10 years, it's generally a few things we help them with. One, tech enablement. The other is establishing a recurring revenue model. And then the third is business financial health. Because once they have those things mastered, they'll have a better chance of, to what BJ mentioned about other options if they choose to get access other capital markets.
Great. Either of the other two guys have anything to add?
All right, this guy will add something. So yeah, the question was about support for the companies in the portfolio. Did I get that right?
Mm-hmm. Yeah, post-advisory support.
All right. Yeah, so we take what we think is a pretty particular point of view on this. As I mentioned, I came out of the VC space and I was guilty of the usual sort of, let me know how I can be helpful and I'm going to be full of value add and all that kind of stuff that I would say to entrepreneurs, knowing full well there was a limited number of things that I would really be able to do because we didn't have a systematic way in which we would really approach it. And the Rolodex really only goes so far. So when Carlos and I started Novel, we were really focused on making sure that when we deployed, when we invested, we were going to be able to bring to the table something that was going to be meaningfully helpful to the companies and to the entrepreneurs that we work with. And so we approach the post-funding support that we call our revenue acceleration platform with sort of three key pillars. The first one is strategic planning. So we know that most small companies that are growing really fast can't really figure out how to carve out time to do a sufficient job of planning for the next 6 months or for the next year. And so we have a really simple templatized way to do that. And we'll actually facilitate that for the companies that we provide capital to. We'll do that. We'll facilitate that once. It is actually so simple that after we do it once, they can actually do it on their own. We do that with each company in the portfolio who wants it. We don't require it, but we offer it. Most companies take us up on it. And then most who take us up on it actually come back to us 6 months later and then 6 months later again after they've run their own process and say, hey, what do you guys think about what our plan looks like going forward? And as they continue to come back to us, they gain more and more confidence with that strategic planning process. And then they have like a framework for resource allocation and decision-making that, at the earliest stages of growing a business is really hard to develop when you're just trying to keep the lights on and make sure people are doing what they're supposed to be doing. And then, as I mentioned before, sales is a really big area of focus for us, obviously, and it probably is for everybody on the call. But we've got an operating partner and a couple of consulting partners that we actually structure an engagement with the companies in our portfolio around lead generation, sales ops, and the technology that they use to run their sales operations. So we work for the first 3 to 6 months with a company on those kinds of initiatives that we agree on up front and help them hopefully accelerate their sales and marketing engine. And then lastly, we will help them hire their next sales hire, whether that's a sales director or a sales VP, maybe it's an SDR, whatever they need, we'll help them hire. We've got a pipeline running at all times. So we try to get the CEOs that we work with in front of the right hires on the sales and marketing side. So that's how we approach it. We do get requests, can you introduce us to investors? Can you do other things? And we try to service those, but we're really good at those three things, we think.
That's awesome. Thanks for elaborating. Alan, anything to add to that as well?
Yeah, so just really quickly, so we do have a growth platform that is a dedicated resource to the companies in addition to our cash. We deliver it modularly in 3 to 4 month sprints, and each of those sprints has a different design around it or a different set of outcomes. But it's all focused around the idea of growth experiments. And this came from our observation that you do one set of things to make it to $1 million. And the next set of things that you need to do to hit the next phase of growth is going to mean that you have to do the thing you did before successfully, and you have to add on something new. All right. You have to build another S curve. And this is very difficult for companies, which is why 4% of companies make it to $1 million and 0.4 make it to 10. All right. It's hard to climb that curve, and it's easy to make mistakes and waste money on the way up. So our team's really built around designing and executing growth experiments to help a company in a capital efficient way figure out how to grow, how to discover the next S curve of growth, and how to make less mistakes in doing it. And because we have hundreds of looks at the problem versus our founders who might have just a couple looks at it, it becomes easier for us to narrow in on a solution, a possible solution, more quickly and cost effectively than they do on their own. And then we unplug that once we're pretty sure they have the capacity internally to do that themselves.
Great. Thank you, Alan, Keith, and Kim for that.
We have some really good questions that were asked here in the Q&A chat. So thank you for those questions, and thank you for the panelists for answering them. My final question for tonight that everyone wants to know about is, what are the final thoughts that you would offer to founders about RBF? Or what is it that you want to leave them with moving forward, saying this is the one thing that you should definitely be focusing on or maybe prioritizing as you're considering RBF? And anyone from the panel can join.
I guess I would probably look at it as, the one thing I would say is RBF is a great way to fund your company and, maintain control, all the things we've talked about. But you should also spend it wisely. It's not the same as getting a $10 million, even if I'm doing a $5 million funding. It's debt. You're going to pay it back over time, and you don't want to treat it like it was a slush fund from 3 venture funds that doubled down and oversubscribed and wrote you $10 million check and have a party. So I think the thing that we've seen is the people who do the best, or they still look at it just the way they did before they had any funding, which is every dollar matters. It's not a slush fund. It's how do I very carefully and strategically grow my company with this new type of capital? And the ones who do that make good use of it. Those that are just suddenly they had no money for many years and now they've got money and they go spend money left and right, often find themselves in problems later. And so I would just encourage people to spend every dollar and dime just like it was your own money and make the same kind of decisions you made to get you to where you're at today. And most likely you'll proceed to the next level of growth and things will all work good. There's a lot of goodness comes with being frugal and careful how you spend your money, because at the end of the day, yes, you're replacing the equity round that created dilution, but you want your company to be successful, and spending your money carefully is always a wise advice.
I'll go next. I would go through and say that give yourself as many options as you can. As somebody who's founded 7 companies, there's not just one way, one answer associated with this. We talked about at the top of this, that there's several different funding options that are available to you. And the assumption that, especially the market that we serve, people think, oh, if I just get this one amount of funding, then the rest of my solutions are addressed. You're going to need the appropriate type of funding that's going to get you to different stages. And then you also want to be able to have the ability to be in the position that's going to create wealth for yourself. And while there's so much hype around equity financing, as BJ mentioned, that, generally the more you take, the less it's gonna, when you look at the multitudes of outcomes that, there's more exits that are less than 100 million. And you're going to have a lot more influence if you can, delaying, selling a whole bunch of equity. So that was it. And the other thing I would say is, I think somebody asked in the chat, what do you do to apply? I mean, all of us have mentioned on our our profiles actually how to contact our company. But it's really about your numbers. So it's your financial statements, your bank statements, those types of things to give you insights of your cash flows and projections. And those things are what's looked at to evaluate, the potential of a fit for your business.
Yeah, and I would follow on a little bit to what Kim said here. Funding is never one size fits all. I think the thing that we have learned from the entrepreneurs that we work with, and some of the things that we try to impart to the ones that we meet, are really, this is a journey, right? And it's like the most fundamentally hard journey that you can decide to take as a founder. Or being a founder. Along that journey, there are just different points where you're going to need cash. You're going to need different kinds of capital. And I think it's really important to recognize that at these different points in your journey, there are different tools in the toolbox that can really work well for you. It's not always going to be equity. Sometimes maybe it is. Sometimes maybe it's not. It's not always going to be revenue-based financing, but sometimes, and I would argue perhaps more often, it will be. Debt finance, bank debt will very likely not be an option until you've reached a particular scale. But if you can kind of understand and look at the different options that you have and really pursue the ones that fit where you are in your journey and what your eventual outcome, what your overall goal is, then I think that you as an entrepreneur are going to be in much better shape because that's how you preserve that optionality that Kim mentioned a minute ago.
All right. Any other final thoughts before we wrap up? Really appreciate it, you guys. Okay, great. Well, thank you so much to our amazing speakers for being here and everyone in the audience for joining, and super thoughtful and educational conversation tonight. Really grateful to be here as well. Looking forward to the next one, and please don't hesitate to reach out to any of us with questions, comments, concerns, animal pictures, anything. We're all ears, and I know we all love talking to entrepreneurs and helping people grow their businesses.
The next one will be in San Diego, right?
Yes, you got it. All right.
Thanks, everyone.
Good night.
Good night.
Thanks, everybody.
Good night.
Thank you all. Thanks. Good night.
Good night.
Good night.